To the business of energy. Pay-as-you-go solar kit business, d.Light, or d.Light if you prefer. They've raised about $18 million from a consortium of lenders. It's designed to help accelerate its growth in Africa. Now, the equity injection will allow the company to expand its product line, but also get into new markets and reach a lot more customers. So how exactly is this going to work? Let's find out. Ned Tozun is the CEO and a co-founder of this firm. Is with me in studio right now. Thank you very much for your time.
Thank you for having me.
Okay, so $18 million. What's the composition here? Is it all debt? Is it debt and equity? What's the composition?
Yeah, in this case, it's actually all debt. And really, as a financing strategy for the company, we're moving from equity investors to debt investors to scale up the business. And we've just seen tremendous growth over the last few years. Just to give you a sense, in East Africa, over the last 2 years, the sales have actually doubled year on year, and we expect it to double again in this next year. So the solar market,
very high growth company.
It is
because that's
booming.
50% plus a year.
Yeah, it's been actually insane. And I've been in this business for 12 years now. So the kind of growth we're seeing in this market is unbelievable. And really, fundamentally, the funding is all about supporting that growth, because a lot of that growth is driven by pay-as-you-go solar, which is basically solar where customers pay over time. So essentially, all that growth, or much of it, is actually being driven by products that we are financing to the customer.
Right. Okay. So we'll come back to that funding structure in just a bit. But because last year as well, you also raised, what is it, another $41 million, give or take?
Yeah.
So total about 91.
Yeah, that's right.
Give or take. So given all the cash that you've raised, I find it interesting that you're moving more towards debt as opposed to equity. Is that because in the current capital raising environment, finding people with patient capital, especially for a business like yours, might be a bit tricky?
Well, really, the funding from last year was all about kind of accelerating our mission, you could think of it. And our mission is fundamentally to make solar products universally available and universally affordable. So that funding was used for making more solar products. So we have a lot of R&D, a lot of new products that will be introduced to the market, making them more available, so new country expansion, even within the markets we're in, going deeper, so we really reach the last mile, and then finally making them more affordable by having new kind of financing plans for customers. So the funding now is really all about taking that foundation and scaling it, and we're finding that there's actually appetite from the debt community to be able to expand that, and fundamentally that's going to be much more scalable because the company is profitable. We don't need to be funding losses through equity anymore. We can actually shift to debt financing, which is then basically on-lended to the customer that we're selling to.
Because essentially, as I understand it, it's a pay-as-you-go system. So individuals, essentially, you have this steady stream of cash flow from 60 plus different countries you can rely on to service that debt.
Yeah, that's exactly right. And we have enough track record now where banks are comfortable looking at it and saying, okay, these cash flows are fairly reliable and we're willing to bank these, which I think is a really important inflection point for our industry.
You're sitting on a lot of consumer data as well, though, aren't you? Because, I mean, because I know your target was to hit, 100 million clients by 2020, was it? So, well, we'll get to that in a moment. But all of these individuals essentially pay either on a weekly basis, monthly basis, whatever the case might be. How valuable a component are you monetizing that data that you have?
Yeah, that's a great question. And right now, we've been so focused on building a great product company, a great distribution business, and then a great consumer finance business that we haven't actually really figured out how to best monetize all that data that we're getting. We also are wary of wanting to make sure we protect consumer data as well. So we haven't been that aggressive in utilizing that data, other than saying for customers who are paying well, we can then upsell them to other kind of products that might enhance their life quality. So whether it might be an appliance like a fan or a TV, something that could be powered by our system, that's something that we can do based on the credit history we have from the customers. But in terms of selling that data externally, that's not something we've done. And we've even looked at things like carbon, because we've offset now more than 22 million tons of carbon. We haven't monetized that at all. But it would be lovely to figure out a way to monetize that somehow and pass that value to the customer so they can get even better value for money products.
If I was a bank CEO, I'd be coming to you right now, breaking down your door and saying, I want the consumer data. But going back to the production side of your business, because I know when you set this up, you and your wife, I believe, moved over to China in the early days. But given all that we've seen since 2017, tariffs on steel and aluminium, key inputs for your business, and then of course tariffs on other things as well. How's that affected your production? Because you're working on really razor thin margins. Yeah,
that's right. And just pricing is so important for our markets. But what we've seen, because there's been a lot of issues between the U.S. and China. We're a U.S. company. but we don't sell in the US, we don't sell in China. So that kind of tariff, those impacts haven't really hit our business. What ends up having a much more dramatic impact on our business is the import tariffs in the countries that we work in.
Right.
So we've been starting to look at things like local assembly that can help us minimize tariffs. But when you look at, for instance, the East African environment, tariffs have generally been very low. And that's really caused this whole industry to boom. And it's very akin to the early days of the mobile phone industry now. But you look at markets in West Africa where tariffs are much higher, and the penetration of solar is like 10x less than in East Africa. And it's purely a tariff issue in my view, because the products are just fundamentally much more affordable here where you have lower tariffs. There are tariffs, we pay taxes, but they're just not exorbitantly high, so we can still have affordable products to customers.
All right, I'd love to sit here and talk more about this because it's a massive opportunity, but I'll leave it there for the time being.
All right, great. Thank you.
Thank you very much for your time.